Hello, everyone. I'm Wayne Wright. I'm the founder and principal of Wright Business Advisors, where we help owners to confidentially exit their business and for maximum profit. And today, I'm joined with a friend and SBA lender, Mr. Tyler Featherston, and he is an SBA lender. His title is Business Development Officer, and he is with Always.bank. And I've known you, gosh, Tyler, for what, about 7 years now or so, or it's been a while.
Yeah, I feel like the first call I made to a broker was to you. So yeah, the the I would say the cold calling. I got what's the word? Um,
A guinea pig? Is that what I was?
yeah, I mean you weren't a guinea pig. I mean you answered the phone and you're like, yeah, absolutely, let's do business together. And then next thing you know, we forms a relationship and a good friendship as far as meeting the families and all that good stuff. And obviously, we know it's a good relationship when you travel from bank to bank and you still decide to stick with me. So.
Amen. Tell us about kind of your experience maybe and what got you to where you're at today.
Um, I kind of just found myself in SBA. I kind of just landed here, right? I coming out of college, didn't really know what I wanted to do with a finance degree, and my dad, kind of dropped the planted the seed a little bit and said, "What do you think about doing SBA?" And first thing that I thought was absolutely not, hell no. Don't want to do what my dad did. Want to make my own path and things like that, but he goes, yeah, let me at least teach you how to spell it. And if you like it, then go find a job. If you don't like it, then you're well rounded for an interview because nobody really knows about this space in the financial world. So I was like, sure, why not? And yeah, next thing you know, kind of like I said, learned how to spell SBA and found a job at a local community bank and found love for it ever since. Just helping business borrowers and owners get the financial capital that they need to either grow or buy a business, buy some real estate. So yeah, I've been doing it for 7 years, just as long as I've known you.
And I know you're passionate about it. You're good at it. And when someone's passionate about something, obviously they're really good at it. Okay, so yeah, maybe to start off, can you give us more of like a high level overview of like the SBA loan process? Because I'm assuming buyers and sellers are, all going to be watching this webinar. Maybe
Sure.
specifically the 7A and the 504 program and,
Mhm.
how they differ, that sort of thing.
Yeah, yeah. I mean, it's you can slice it up in any which kind of way you want to, right? The SBA process is going to be the SBA process wherever you go from an institutional level. Obviously, there's some lenders out there that are better established, more prepared, kind of know what they want to do and how they want to do it, and they can act on that and produce on that. But most of the time, it's going to take roughly around 45 to 60 days. It's a government funded program, so it's going to take a long time. So I make sure I tell everybody that on the front end. And basically the time clock starts when we gather a full application, and full application is so vague. I always put an asterisk on that because it's going to be different again wherever you go. But at least a good financial package, last 3 years of business tax returns, an interim statement on the P&L and the balance sheet, and then your personal financial information, tax returns. We'll provide you with the PFS if you haven't already provided one, and that
What's
can
the
kind of give us
financial statement,
a
right?
yeah, personal financial statement.
The front.
Yeah, I'm a banker. I do the acronym thing, so get with it. And so once we have that information, then it allows the lender to understand the deal, structure the deal, and then kind of start to gather the rest of the documents needed to do the loan. But once you get into underwriting, it's a probably a 2 to 3 week process, and then once you're in closing, again, it's really contingent upon checklists. I think we'll come back to that, but I think there's SBA is a checklist type of game. You get a pre-underwriting checklist, you get an underwriting checklist, you get a closing checklist. So as fast as you can knock off those items, as fast as you can get the loan done.
Okay, very good. So the 7A loan is more for the business acquisition, and the 504 is more for commercial.
Yeah, I mean, there's pluses and minuses to each program, right? So the 7A program it's all fully funded by the one institution, and you can do commercial real estate in it. You can buy businesses in it. You can get access to working capital. You can do debt refinances. You can even buy equipment with it. And similarly to the 504 program, you can buy real estate or do construction types of loans. Heavy equipment can also be utilized for the 504 program, but you can't buy any businesses unless there's CRE involved into it, and things like that. And then the kind of caveat to the 7A program there is that you're working with the lender, as well as a certified development company, also known as a CDC, and they also finance 40% of the loan.
So what percent of your transactions are 7A versus 504?
100% are
Okay.
7A.
And so you're doing the commercial real estate, the CRE, as well as the business act under 7A, and you're not really doing much on the 504?
Correct.
Okay. Why is that?
Um, I mean, at the end of the day, from our institution, we like to, we're not a portfolio lender. So we do sell our deals in the secondary market. So, utilizing the 7A program enables us to do that and sell our deals in the secondary market. And we're not really doing any ground up construction that would be, really a good fit for the 504 program. But at the end of the day, I mean, me, I'm an acquisition lender through and through. So 7A is the name of the game for me.
Okay, great. And since we were talking about acronyms, let's talk about the letters PLP, or Preferred Lending Program. I understand you guys are a PLP lender, right?
We are a PLP lender, and that allows us to, act on behalf of the SBA to approve our own loans, close our own deals, without really getting a lot of look through the SBA, like you would on a GP or a general processing lender.
Okay. So it streamlines the process. And I mean, instead of it being, you might shave 30 days off the process or so. I know I've tried non-PLP lenders, and I think it's been typically about 30 days longer if you're not using a preferred lender like yourself.
Mm-hmm. Mm-hmm. Yeah, I mean, I think my GP friends out there are saying that it's a little bit faster process than it used to be. Definitely when we were first getting started, and I was first getting started in SBA, GPs were taking roughly around an additional 30 days, but they've enhanced the process a little bit, but you still have to get technically two approvals to move it forward.
Okay. So the SBA 7A program typically does loans maximum up to 5 million, right? Unless
Yep.
there's the fancy Latin word para passu. Maybe you can talk about that a little too. Do you do many of those?
Yeah. So the 7A program can go up to 5 million. You can utilize a conventional bridge loan on deals that are over five million. We don't technically do them very often. They're going to have to be relatively strong deals, strong borrowers, that you often, let's call it spade a spade. Borrowers don't fit in that kind of space when you're thinking about an SBA loan. So their PFS is generally light, but they have a really good experience, or vice versa. They have a really good PFS, but you got some transferable experience that can pose as a weakness, which kind of filters them to that SBA process. But but you can go up to the $5 million cap on the 7A, and then if it's a $3 million conventional loan, with your specific lender that does those, you can do that as well with different terms. They're two loans.
Okay, very good. I keep thinking about a lot of the buyers that I deal with are sort of chasing the lowest rate, and I know that's never anything you want to hear as lenders, but I know you're all pretty competitive. I think the prime rate as of today in early November is 7%, and then you add 1, 2, 2.5 points. Some lenders 2.75. But as you and I know, the difference between, say, even 50 basis points or a half a percentage, for example, it doesn't typically make or break a deal, right? It's about execution that really does.
Yeah, I mean, I think I have the conversation with borrowers on a regular basis at this point, right? Of the difference between rate and getting the deal done, right? If they have their tainted glasses on and they're just focused in on the rate, then it's a hard conversation to have technically, because they're just focused in on rate. Now there's lenders out there that will can charge those low rates, prime plus one, or just prime fixed for 10 years on acquisitions and things like that. But truly at the end of the day, I think from a borrower's perspective and a buyer's perspective, you gotta be asking the right questions. It's not always just about the rate. It's about, does that institution's SBA shop know how to underwrite and do business acquisition loans? Do they know how to structure them correctly? Are they okay with seller notes or forgivable notes and things like that? And that the way that you structure the deal is oftentimes how I like to win the deal. And by saying, hey, you're going to pay a little bit extra, maybe prime plus 2.5 to 275, maybe a little bit lower, but at the end of the day, you're going to have everybody in your corner that is supporting this deal and structuring the deal in your favor, but the seller's favor as well. So, at the end of the day, we're all a team. And it's about making the best deal possible. And maybe the LOI that I get the first day isn't really what we land upon, but that's the value that I bring of knowing how to get the deal to the closing table.
Yeah, it's been great working with you. How we structure these transactions, we look at debt service coverage ratio and what have you, and stuff that your underwriters would do. And then, well, that won't work, but we can structure it this way. And if we do this, it's really been super helpful, because when we do finally get serious and move forward with the transaction, I would say it closes nearly 100% of the time. So it's just being prepared. Do you think a buyer should choose the bank, or should they choose the business development officer that they want to work with, and why?
Ooh, that's a good question. That's a good question. I mean, I'm a firm believer of people like doing business with people they like. Um, and if the BDO is really truly wanting to help the borrower and getting to the closing table, I think that goes a long way. The BDOs are the ones that are quarterbacking the deal, from the discovery call to the last rush to needed items to close the deal. And if there's any heartaches or anything like that needs to be handled, it's the BDO's job to handle that, right? So we always have the relationship with the borrowers. We always have obviously with the sales or the credit team, the closing team, and so that goes. I think that goes a long way. But I think that from a borrower's perspective, if they have a long established relationship with a commercial lender, for whatever reason at a larger institution, you're not going to go wrong there. But stick to what they know, right? If you've done an SBA deal with an institution and it went well, then go to that path of least resistance. But if it's a completely new idea, you're expanding into a different industry and you're buying a business, or you're just buying a business right off the bat. I mean, I don't think your personal deposit relationship banker is going to point you in the right direction. And it might be wise to then utilize you, Wayne, obviously, to say, hey, this is an SBA deal, never done it before. Who should I be talking to? And then, obviously you're talking to lenders all the time, and of course you're going to just send them to me, but you got to give one or two others, I guess. But
Yeah, we always worry about directing people, but I mean, I'll give a couple, names, and but what sets you apart, always is the communication. And I know I can call you anytime and structure a transaction together and look for caveats. You'll run it up the totem pole to the underwriter, and it's like, this is what we'd be concerned about. And so we put together a plan to mitigate risk. And if it's a no, that's okay. We like the quick no's, as well as the quick yeses. And so I think we have a good thing. And I think that's where you kind of stand out with a lot of SBA lenders, is your ability to communicate so well. And I appreciate it.
yeah, no, I think, I mean, I think it's beneficial, right? I think starting the conversation early on a deal is important. Um, Now when we're just looking at the business and we're trying to pre-qual the business, there's one half that's missing, obviously, and that's the buyer, right? And I think that we do a good job of kind of thinking, outside the box on hypotheticals here, where what type of buyer is going to be needed for this business, and let's kind of structure it that way, and then as the buyers come through, let's kind of filter them out as quickly as possible to where we find that buyer that fits the mold, right? But there's we can only go so far. It's like, yeah, this is a really good business from an SBA perspective. It cash flows. There's good collateral in the deal. It's been around forever. It's not owner dependent and all that kind of stuff. It's like, okay, now that's easy, right? Now the hard part is obviously trying to find that right buyer that fits that business, which again, in that SBA process, if we have half of it figured out, we can easily just kind of have one discovery call with a buyer, say, yeah, this guy's, knows his stuff, or he or she knows his stuff. And let's go with it. Or, nah, this one isn't really a good fit for me. And best of luck. If you find another buyer, let me know, kind of thing. But yeah, I love the way that we handle it. It's efficient, right? In a process, and in a world that there's so many things that just go awry, right? On every single transaction, there's something that goes wrong. And so if we can control what we can control as far as, understanding a good structure, not having to fluctuate on that, having those tough conversations with the seller early on versus, a week from a week from closing, like, hey, do you want to carry a note, kind of thing? We already have those types of conversations, which I think is a really good value add for your clients and your sellers.
I agree. Appreciate that. Are there any like industries that your bank is particularly like bearish on right now? Ones that are under like a heavy scrutiny, and why?
Um, I think, the, oil and that's kind of a hot
Oil and
button for
gas.
us.
Uh-huh.
We're not really heavily concentrated in any specific type of industry to where it causes any concern from that perspective. We're more of we're an institution where, I hate saying this phrase because I think everybody does, but it's common sense, right? There's going to be outliers in industries like construction where, maybe it's a relatively high risk industry for most of the banking industry out there. But there's definitely outliers out there that, they have good businesses and good models and they know what they're doing. And a good buyer comes along and does, wants to buy that business, and we'll do those. So, it just all comes down to, how does the business make money? And why does this buyer want to buy the business? And then we kind of go from there, but we're not, tied down to, no, we're not going to do this and that. Versus, actual kind of products. So as far as, ground up construction, we won't do any of that stuff. We're not going to really do any startups. Unless it's maybe a franchise with little to no TI kind of thing. We'll do those types of deals, but we'll stay away
tenant
from
improvements.
tenant improvements. Correct. Yep.
Here we go with these acronyms.
Yeah.
All right, let's use another acronym, SOP. So
Sure.
this year the SBA released, some updates to the SOPs. Can you give us like a quick update on these changes on the standard operating procedures, and how they affect buyers and sellers?
I feel like it changes every month. So it's all over the place. The biggest thing that's happened in your world, Wayne, is they allowed for a hot second buy-ins, where buyer can buy into a certain percentage, the seller can stay on in a certain percentage, and the
Some equity.
seller can stay on. Yep. And now that has changed to where, they can still do that, but the seller will need to personally guarantee the loan for 2 years. So that's a pretty big hot button. Allowed, the licensing types of businesses to get done and all that kind of stuff. So now the seller has to guarantee that. And then, there's a lot, right? But, the seller notes, you have to have them on full 10-year standby if you want to treat them as equity, which comes into play a little bit more often than we expected. But it's the old rules. So, we sold that before. So it's just, it's about getting the deal done. So there's that. And then, the more of just things that are not eligible now. So, MCA debt is, you can't refinance that anymore. And
explain what that is.
Merchant cash advances. So I would say it's a hard money loan per se. It's super high interest, paying daily often on receivables or invoices. So it's maybe a product that is needed for a specific type of business, but not every business. But those are ineligible now. And then I think that's really it on the BizAct side as far as the main things that have changed going forward. So I'm hoping that it kind of stays the same for a little bit, so we kind of get into a rut, but it's probably not going to happen. It'll probably change back to something.
Okay, good. Thanks. I always tell buyers and sellers that, like, two main criteria. Most of the transactions that are sub 5 million or whatever, they're not really looking at return on investment so much, but they're looking at paying that buyer a suitable salary and then covering the debt service on the loan. So maybe for some first time buyers or even sellers that are, they hear the term maybe credit box, and debt service coverage ratio. Maybe you can touch on that a little bit. Um, like
Sure,
how you look at that.
sure.
So are you talking kind of like just the overall credit box,
Yeah, I
or
mean, you hear that a lot with, like the big question brokers ask lenders, talk to me about your credit box.
yeah, 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 yeah. I mean, it's obviously
It's a good question to ask everybody, but I think that the key thing there is there's a difference between the SBA SOP and then the credit box, right? So, the SBA will allow you to do certain things as far as, again, to your example, debt service coverage. So the minimum debt service coverage on an SBA deal to qualify is 1.15. Now, there's probably some lenders out there that are willing to do that, but most of them are not. So they have a credit policy that will, maybe have a stronger debt service coverage, 1.2 in historical periods or something like that. And so,
Five, some of them more
yeah,
conservative.
yeah. Some of them are a little bit more conservative than others for sure. And so yeah, there's a key difference there. Our credit box, I mean, we don't like to call it a credit box because we don't want to be stuck in parameters. Is basically what we feel like. So, we have guidelines that kind of state like, debt service needs to be 1.2 in 25 and in 24 years. And if that scratches the test on as far as the loan size, then you're good there, and you can move on to the next phase kind of thing. So we're not really stuck on specific rules, because again, there's going to be outliers in the business to where maybe it has light debt service coverage, but there's something else in the loan that really strengthens the deal to where we don't have to put credit policy exceptions on everything. We can kind of just make that assumption and make that determination right away and kind of just move on and get it approved.
Like a larger buyer down or a larger owner carry.
Say that again.
Like a larger buyer's down payment or a larger owner carry to help mitigate risk.
Yeah. I mean, that goes into that just kind of goes into like overall structure, right?
Standby periods.
Yeah, standby periods. Every bank is going to be different, right? As far as what they want to see on a seller note, right? For us, having maybe a standby period so we don't have to count it towards debt service coverage is the way that we get there. Or we have the buyer bring in some more cash to kind of bridge a gap of a weakness per se, right? Or we just have them lower the price, but we know how difficult that is.
Oh yeah, very difficult. As brokers, we don't get as much commission,
Yeah, right.
Yeah, that's pretty interesting. So when you calculate debt service coverage ratio and adjusted cash flow, can you explain to our audience maybe which EBITDA add backs are generally acceptable and which ones really don't fly with SBA lenders?
Yeah. The thing that I think that I've tried to grill into your brain. We still have conversations on every deal on, this one is an add back. And I'm saying, I don't know if this is an add back. In my world, and this is just me speaking personally, right? I think I want to look at the debt service of the deal with just adding back just basic EBITDA, right? And adding back a one seller salary. If there's two sellers, then I'll add both of them back.
Make any adjustments,
their functions
if they're underpaid or overpaid and all that good stuff. Spouse.
Yep. And then taking, having an understanding of the buyer and taking a reasonable salary, right? Kind of thinking about what the business valuators are going to be doing. And then we'll get a little bit more detailed once the buyer comes along and all that. But so I'll do that. And if it cash flows off of there, then, the pool in the backyard, the travel expenses, the cell phones, all that kind of stuff that aren't necessarily going to move the needle, don't really matter. I don't have to play the game of this needs to be add back to do this deal.
You answered it well, I think. How about curveballs? Every deal's got curveballs. I'm thinking like common roadblocks. I'm always explaining this to buyers and sellers. They can slow or derail the SBA closing process, like last minute landlord approvals. I mean, I try to get them to reach out to the landlord, talk about, how much term's left on the loan. I know with the SBA, the lease has to match the term of the SBA loan, which is a 10-year on the 7A. And so, that could be a real problem. UCC liens, what else? Working capital. There's so many crazy things. Licensing.
Licensing, yeah, titles, you
Yeah.
know, sellers not deciding to register their vehicles and,
Mm,
running into that, trying to perfect liens on the SBA.
tax
Um,
status letter.
yeah, yeah,
Last minute.
yeah.
And that takes like 2 weeks sometimes.
Yeah. I think the last one that we did was the liquor license and, the
Mm,
battle with that. That was a long curveball. That was during COVID
yeah.
and all that. Um, there's going to be something, right? So I think for buyers just need to understand that right off the bat is there's going to be something that goes awry, and we don't know what it is. But we're going to handle it together, right?
That's good advice.
And
Yeah.
push our way through it. I think again, it's about choosing that right institution, asking the right questions to that specific BDO. Is that BDO going to not pick up the phone on a Saturday because you couldn't get your liquor license done, and it's going to derail the process? I think the good BDOs out there, the best BDOs out there, are kind of foreseeing these issues, and then resetting the expectations, right? Again, I think it goes into the world of, or the phrase of, control what we can control. From a lease perspective, the BDOs should be advising the clients on this type of stuff earlier on, because it's a long-winded item, or could be a long-winded item when you get into closing, and they're going to be so fatigued at that point to where everyone's just going to get frustrated. So if you have those conversations earlier, then your likelihood of getting things getting things done in a smoother way is going to be more probable.
Amen. We're about ready to wrap this up. Is there anything else you'd like to say to potential buyers or sellers or brokers?
Yeah. Don't discount the SBA process. Everybody says it's long. Everybody says that you have to, you have all of this documentation you have to provide. That's all true, right? I'm not going to sugarcoat that, but it's a really good program. Offers the low payments for your down payment, fully amortizing loans, no balloon payments, things like that, to where it really can benefit a first time small business owner, or even a business owner that's just looking to expand. If you choose the right lender that really knows their stuff, then you'll have a good experience and ultimately make your dreams come true.
That's awesome. Thank you. Thank you for your insights. It's always
Yeah,
great having you on. And I guess for
likewise.
anybody anyone that's interested in connecting with Tyler for any future SBA lending or financing, we're going to put his contact information below. And for our attendees, thank you for joining us. Appreciate it. If you're exploring buying or selling a business and you want help in determining valuation or deal readiness, feel free to reach out to us here at Wright Business Advisors, and my contact information will also be below. Till next time, thanks again, and I appreciate you, Tyler. Appreciate your time today.
Yeah, likewise, my friend. Talk to you later.
All right, bye.
All right.